In this video, I'm going to talk about the adjusting entries. This is in my series of accounting foundational knowledge, and I already started talking about adjusting entries, and in this video, I'm just going to continue on with those lessons. First of all, just as a refresher, adjusting entries are done at the end of the accounting cycle. You would be recording revenues in the period earned, expenses in the period incurred, and updating asset and liability accounts. There are several different types of adjusting entries, and I already gave some examples of deferred expenses. And in this video, I'm going to focus on deferred revenues. And then in the next few videos, I'll talk about accruals and depreciation. A deferral is an income or expense that is not recognized until a future date. So these are situations where the cash has already been exchanged, but the income or the expense hasn't happened yet. And specifically, we're going to talk about deferred revenues that are advance payments from customers for the product or the service. So in other words, the customer prepays or pays a down payment of some sort. And another name for this is unearned revenue. Unearned revenue would be recorded as a liability account, and that's just because the business owes the customer the product or the service. And then once the product or service is delivered to the customer, the amount of that sale would be moved from unearned revenue to their service revenue or sales revenue account or whatever account they use for their income. And later on, at a later point in these lessons, I'll talk about what is considered delivered to the customer as far as, is it when the goods leave the warehouse? Is it when the customer receives the goods? And I'll talk about some of those situations. But for service revenue, you would be looking at when the job is complete, when the service is provided. Typically, that means when the job is done, although a job could be partially done. So we're going to talk about that a little bit more in just a few minutes. And this is just a visual picture of what's happening. You have the unearned revenue when the company receives the money from the customer and they owe the service at this point or owe the products at this point. And then when they deliver the service or deliver the product, that would be a regular revenue or income account. And keep in mind that this is based on accrual-based accounting. So if you're working for a business that uses cash basis accounting, then when they receive that money, they may just be recording that as a revenue immediately. So just keep in mind that these adjustments are based on accrual basis accounting. Okay, so then we are going to look at the actual adjusting entry. If it's recorded in an unearned revenue account, when the money's received, at year end, they would want to look at this account to determine if there are any amounts of money in that account that represent sales that have been completed or partially completed. So they deliver the service when the job is completed, but if it's a big job that is going to take several months or several weeks, they may break it down into pieces and stopping points, or they might break it down into percentages of that total job. So for example, if they've completed 50% of the work, they might want to go ahead and record 50% of the revenue. So in general, it's when the job is completed. However, there are situations where you would record a partial completion. And then they would want to do an adjustment for those situations. The adjusting entry would be used to show the revenue earned by transferring it or a portion of it from the liability unearned revenue account to their regular income or revenue account. So let's look at this with an example because I feel like this is going to be easier to show you with actual journal entries and T accounts and amounts. Okay, so for example, if a company received $5,000 in advance as a down payment from a customer for a service that will be provided later, they would record that as a debit to checking and a credit to unearned service revenue. And then at year end, they would probably be looking at the unearned service revenue account to determine if there was any amount of money in there that they had earned. Because you wouldn't want money in an unearned revenue account if they've earned it or earned part of it. So if they look at this job, they look at this situation, and they realize that they've performed 60% of the work or $3,000 of the work of the services, then they would want to move that $3,000 from the unearned account to the service revenue account. So this is what the journal entry would look like. You would be debiting unearned service revenue for the $3,000. So you're doing the opposite of what it was up here. Up here it was a credit to add to it. Down here it's a debit to subtract. So unearned revenue is a liability account. You add to it with credits, subtract from it with debits. And then you would be adding it to service revenue. This represents their earned revenue, and that would be a credit. You add to revenue with credits. In this second journal entry, you're simply moving it from unearned to earned. Let's look at that in T accounts. The first entry was a debit to add to checking, credit to unearned revenue to add to unearned revenue, add to the debt of the business since they owe that service. And then at year end, they did an adjustment to debit unearned revenue, which is going to subtract from the credit balance. And then they credited service revenue to represent the money earned. So if you were to get the balance right now, there's $5,000 in checking. Of course, they would have other transactions here in a real business situation. Unearned service revenue is now down to $2,000 when you take the $5,000 credit minus the $3,000 debit. And then you have $3,000 in service revenue. So this balance represents the fact that there's still $2,000 unearned. And this represents the fact that there is $3,000 of revenue that they earned. And these balances would be on the balance sheet, the checking and unearned revenue, and this would be on the income statement. And that's all I wanted to cover in this video. I'm going to do more adjusting entry categories in future videos. If you have any questions, feel free to comment below, and I'll see you in the next lesson.